Well, welcome to the last panel of the day. My name is Joe Sanderson, and I work with Domain Timber Advisors. And we have a couple of folks here from the TIMO industry in the United States. And I'll give you my quick background and then turn it over to our illustrious panel. So I've been in the timber industry in the United States for 39 years. And so I've spent my career working all around the U.S. managing forest lands for Domain Timber Advisors. Prior to that, with U.S. Trust, putting together timber portfolios for high net worth individuals in the separate account space. Before that, I worked for Plum Creek Timber for 16 years, and during that time, we grew to be the largest private landowner in the United States. And prior to that, I was a logger. I grew up in a logging family, started hauling logs with a log truck when I was 14 under the Farm Bill that exists in a lot of western states. So I was driving a log truck before I could legally drive a car. You might ask what a logger from the state of Montana is doing in London on a panel like this, and really my job is to introduce two very smart people who are here to talk about what's happening in the TIMO space in the United States with timber management, as well as with other ESG and carbon benefits. So furthest to my right is Eric Cooperstrom. He works with Manulife and works in their carbon space. He has over 15 years experience working with carbon. Prior to his time at Manulife, he worked with New Forest and the Nature Conservancy, and has an illustrious degree from Johns Hopkins University. Mary Kate Bolin, next to me, closest to me, works with FIA. She has over 15 years experience as well in the space. Spent a good bit of time at New Forest prior to her time at FIA, and has a degree from Stanford University.
Even two.
So welcome to the group, both of you. We're happy to have you here.
Thanks, Joe.
I'm going to. So as we look at the TIMO space in the United States, you know, there's been a long history of timberland management and kind of transition of timberland from integrated forest products companies to private land ownership. And so that's created a lot of opportunities for different asset values to come from the forest rather than just pure timber production. So we're going to look a little bit at carbon sequestration and the needs for it to be intensified, the dual use for carbon and other natural wood products in this space, and a few other things. So do either of you, I guess Eric, initially, do you have any thoughts on, you know, how we can utilize the forest for pure timber production, but also take advantage of ESG, the ESG benefits that we have as private landowners in the U.S.?
Yeah, absolutely. And thank you, Joe, and thank you all for sticking it out to the last session. I promise you we'll get to cocktails soon. So first, a bit of a introduction to Manulife Investment Management. So Manulife is a global Canadian-based financial services organization, and Manulife Investment Management, for which I work, has a timberland business and an agriculture business amongst other private assets. And our timberland business is the largest institutional investment manager in timberland in the world, about $11 billion of assets under management, nearly 6 million acres. And on the agriculture side, we're the second largest institutional investment manager of farmland, and those numbers are around $4 billion assets under management and about 400,000 acres. So on the timberland side, you know, when we're talking about core traditional sustainable timberland, you know, first and foremost, that word sustainable rings out. So, you know, we have a 35-year plus history of managing timberland sustainably. We were the first North American manager to certify 100% of our timberlands to SFI or FSC standards. And that core sustainability really is a through line throughout our business, both on the timber and the ag side. And we're vertically integrated, and we have farm managers and foresters who make up the bulk of our staff. And so we can pull that sustainability through from acquisition underwriting all the way through to property management. And so when we look at Timberland, first and foremost, we're looking at a sustainability lens. We integrate that into our underwriting through an ESG checklist. And we're constantly looking for certainly core timber value in those core strategies, but also looking on how we can layer additional value-added services. So within our operations team, we have a value-added services team that looks at recreation leasing, looks at mitigation banking opportunities, and carbon through my role especially, but through many of my colleagues' expertise, is quickly becoming more of a focus as carbon markets evolve, and we're seeing that through this conference, certainly.
Thanks, Mary Kate. Would you like to take a swing at the first part?
Sure. I'll also just quickly introduce myself and try and swing back to the timber and ESG duality, which is really important. So it's great to be here. Thanks again for sticking with us. So we've got how many minutes to count in? It's past 5 o'clock somewhere. We got 35 minutes till 6 o'clock. So we'll try and make it worth your while. A little bit of background about myself before FIA. I think you've got 3 TIMOs on the stage, which doesn't happen very often. And I don't want you to think we're just up here going to shill North America for no reason. So I'm going to try and give you some facts throughout the day and stats that help rooted in what's really happening out there in the real world. And you can take the stats words for it, and I'll give you sources if you need them. But one of those first stats comes with who I am, and I am newer to the North American timber industry. I grew up in New Forest, focused on their ESG and impact framework that we built out over a decade ago, and really was centered on Asia Pacific before moving back to the States, where I'm from, in 2018. And since then, have really been taking a much closer look at the U.S. forestry side of things. It's not where I started, so again, hopefully that'll give some context so you can kind of compare and contrast North America to other developed markets, but also emerging markets if you like. But one constant in my career, I've lived professionally in Sydney, Singapore, San Francisco, and now Atlanta. And I got this question all the time. Sydney, what are you doing with timber there? What are you doing with trees in Sydney? Singapore, they don't have trees. Well, they have plenty of trees, but they don't cut them down very often. San Francisco, definitely not trees you can cut down there. In fact, people get really angsty if you start cutting down the redwoods down in the city. And it's still, I get this in Atlanta, and I find this hilarious because, I don't know if there's any American foresters happen to be here? Okay, if there's one American at least. Woo, okay, thanks. Yes, an American forester. So what is America's #1 private working forest state? Georgia. We've got 22 million acres of private working forests. For reference, that's more than 7 times the whole of the UK. So that's kind of what we're talking about and why, working in forestry investment, I'm in Atlanta. And I raise that just because I think it's useful to recognize that we're actually kind of not very familiar with a lot of the forestry facts in our lives. There's a real big detachment between public perception of forestry and what happens on the ground in good forest management. And I think that's a problem our industry faces. And this session originally had a top bullet point of why is the TIMO model failing in North America, and what does that look like? And I was like, let me add it, because I don't think it is, but I think we have a major public relations issue with the forest sector. There's been great proof points throughout the day of all sorts of people working managed forests that produce timber also produce ESG benefits. And that is absolutely the case in North America. It's the case in everywhere that you have sustainable forestry. And I want to share today, I'll come back to them when we have time, but some of the points around proof points on carbon and climate, but also things that have been a little bit discussed less here. We have talked about biodiversity. I've heard water very, very, very little today. 30% of the US's drinking water comes from forested areas. Phil, you've got to be an American forester. No? Not originally? Okay, you could sub for one. I was like, why didn't he raise his hand? Sorry. But these are the facts that people just don't realize. If we want clean drinking water, we need responsibly managed forests. If we want to safeguard the 80% of biodiversity that lives in forests, we need those forests managed and watched. And we heard great ideas about remote sensing. But what happens is there's actually this asset class with 30, 40 years of experience in managing biodiversity and managing water benefits and managing the carbon growth in a forest, because when you're managing carbon, you're managing timber. And those are part and parcel. And I will just wrap up with addressing your core question. I don't want to get the quote wrong. I said, don't take our word for it. So there's these folks. They call themselves the IPCC. This is a direct quote from the IPCC August 2019 special report. A sustainable forest management strategy aimed at maintaining or increasing forest carbon stocks while producing an annual sustained yield of timber, fiber, or energy from the forest will generate the largest sustained mitigation benefit. So yes, the answer is yes, Joe, absolutely. Timber and ESG go hand in hand. And I don't just mean wood in the forest, I mean wood in our lives.
Thanks. All right, we'll go on to kind of the next question that we thought we'd address. You know, given that the U.S. is the largest commercial forest in the world, with very diverse ownership, we have timber REITs, we have TIMOs, like the three of us. We have a huge amount of private non-industrial forest land. Around 60% of the U.S. private timberland is non-industrial private landowners. And given the diverse usage of these forests for recreation, for timber production, for carbon benefits, for endangered species, I'll have each of you answer this question. How do you analyze and manage for the additional demands of the forest, like carbon and ESG, from maybe even from an underwriting standpoint and a management standpoint?
Yeah, I'll take a first swing at it. So, you know, we are constantly looking at what we call the investable universe for institutional timberland. And, you know, in the US especially, where, again, deepest market, most liquid market in the world for timberland investment, we've estimated that the institutional supply is about 150 million acres. And that translates, 120 million acres. That translates into about $150 billion of value. And, you know, that is from a kind of pure timber value perspective. And I would think of additional uses, additional value, like carbon, for instance, kind of as a Venn diagram that overlaps with that institutional timber value. And so carbon has the potential to open up new opportunities in the investable universe, you know, at a very low carbon price point, and everything kind of depends on the carbon price point and what your expectations of future carbon is. You know, at a $5 per ton price point, you're looking at kind of 1/3 of the value, so call it $50 billion. And that overlap, you know, is not so great. Those are often different geographies than your kind of blue chip timberland geographies. You know, at $5 per ton, you're not going to be able to go to an area like the Pacific Northwest, especially the west side, and compete with timber value. Same for the US South. You might be able to go to different regions that have lower land values, lower timber values, lower integration with regional mills and lumber markets. But certainly as the carbon price increases, you know, say to $40 per ton, we see a doubling of potential value, you know, up to 2/3 of that $150 billion factor that I noted. And so, you know, you have this flexing as the relative price of carbon to timber kind of changes over time. And, you know, the last point I'll say on that is that, you know, it's generally a finite market, right? You can look at reforestation, afforestation, but, you know, land typically is finite, and investable institutional timberland is hard to expand rapidly. You know, there are certainly some very interesting and worthwhile greenfield investments. We're developing our greenfield strategy as well, but you know, there is that kind of set stock of investable timberland, and as carbon prices change, you're going to see this dynamic where carbon-focused investors and traditional timber investors start to overlap more. And, you know, as Mary Kate said, that sustainable fiber supply is so critical to circular economics, to, you know, sustainability and sustainable usage, that you need both. And there might be tailwinds that push greater timber value and greater carbon value from a timberland investment perspective at the same time, and very interesting interactions as those markets interact.
Yeah, I can pick up on that a little bit as well. You know, I explained my background, and I didn't really pivot to Forest Investment Associates, but so a little bit further context where I'm talking from, so we can talk about how it works through our process. We're a TIMO, a Timberland Investment Management Organization. Born in 1986, we are 36 years and 1 week old today, specifically. It was last Monday was the anniversary. And so we've been managing forests for a long time. We do that on behalf of institutional investors primarily, and we manage around 2 million acres in the US, Brazil, and Chile. also looking at global opportunities, but here we're focusing on that core North America focus. And we are known as being a very strong southern TIMO. We manage around 1.5 million acres across from sort of the Gulf up through maybe up to Virginia. The Carolinas isn't just touching Virginia. And interestingly enough, that area is actually the world's most recent IUCN biodiversity hotspot. It's the coastal plain of the eastern and southern US is a global biodiversity hotspot. And if you think about all the activity that's happening that's making that a hotspot, that means there's both high endemic species, there's also high threats to those species. There's only really one industry that is operating under a certified basis for responsible management within that biodiversity hotspot, and that's forestry. And it's awesome to hear, what Manulife and Hancock at the time did, becoming the first 100% certified TIMO in the space. What's cool is that is fortunately no longer rare. It is almost every one of the TIMOs. I think the last time I looked at it, anyone managing more than $1 billion in timberland in the US, it was like 12 out of 13 had a public or full commitment to certification. And I'm happy to say FIA is one of the joiners to that club. If and when we get our audit reports, we'll be at 99% certified. And I'll tell you, there's one holdout client, and I'd love to talk directly with them, but we haven't made that happen yet. But this is, our industry has evolved to improve that certification, and what that does is give us quite a lot of certainty over safeguards in management. And safeguards is a word that I don't think we've actually used a lot within our industry, but if you come from kind of the carbon world or you come from an impact investing world, it's really important to make sure that your business is not doing harm to the environment or society. And that's where safeguards are. And that's where I'd kind of position things like SFI certification and even FSC or forest stewardship certification. These are making sure we do no significant harm. The Europeans in the crowd, that phrase, do no significant harm, might sound familiar. It is now being mandated. If you say you have sustainable finance, you're going to need to prove you do no significant harm. But what we're also now seeing across the TIMO space is this idea that we also want to contribute to solutions. So that, again, might sound familiar to the Europeans. How do we know we make a substantial contribution to an environmental or social good? And I think that's where you're coming from, Joe. What are we starting to do about that? One example would be, and my colleague Dan, who's in the crowd, might curse me for talking about something before it's fully signed and delivered, but we are very close, as we'd say in America, we're on the 1 yard line. And with a client that's coming on board with what will be our first climate-linked mandate. And that's really, truly exciting to me. TIMO, 36 years old, and we've been managing and growing trees, which is a vast storage of carbon, 150 million tons or so in the above-ground biomass of our trees. For the first time ever, we have a client who's saying, hey, manage these trees for financial returns and climate returns. So that has caused us and given us an opportunity to think differently about every step of our investment process. Fortunately, we've had the ESG from the kind of risk lens embedded in with integration from pipeline, due diligence, the way we're sourcing transactions at the beginning through to due diligence to the way we actively manage and even into exit. We've done that, but to put a specific climate mandate throughout every step of that means everyone in our organization has to do something different. You can imagine how popular I am when I say, you're doing your job great, can you do one more thing, please? And could you think about doing this other thing different for this special client who also loves the climate and wants to see our investment management for them contribute to a net zero goal. And that net zero goal is going to link to the lives of the beneficiaries, the pensions in their European domicile. Super exciting. But what looks different? We have to construct a slightly different target portfolio because we're looking for constant drawdown from the atmosphere of carbon every year. You can't just buy a slice of that liquid timberland market and do that. You need to buy forests where you're confident you can improve the management, constantly have net growth over harvest, and keep that up and sustained forever, or until technological carbon capture is so cheap no one needs our trees anymore. So let's not talk about permanence. But that's how we build a portfolio that's different. We're going to actually manage it in a different way because we, again, need to manage harvest versus growth. It means when markets are up and timber prices are really high, our guys are going to have to decide on timber sales contracts with another variable. And this was mentioned, one of the first comments today was 3 dimensions of risk, return, and impact. I would challenge that is more than 3 dimensions now, because I'm giving you 3 if I say risk, return, and climate impact. But what if we add biodiversity? What if we add water? What if we add rural jobs? All of these things provide different opportunities, but also put tension on the equation. So your Venn diagram is going to get confusing, which is a good thing, as our investors and our clients start asking us more sophisticated and challenging questions about how we really balance trade-offs. And I don't think any of us should be naive that there aren't trade-offs. And I think that's where the original question of why is the model failing is coming, because we haven't been acknowledging the trade-offs, but we really should talk about them.
Yeah. So, in my travels around Europe, and to your point a minute ago, there seems to be a significant amount of capital looking to be placed into U.S. assets for carbon insets and carbon offsets. At the same time, in the southern region of the U.S., population growth over the last 5 to 6 years is around 35%. There's a huge cohort of the millennial generation that's becoming home buying
Californians
age.
moving to Georgia.
Yeah, California, New York.
Yeah.
So you've got this huge forest land with highly productive soils. You've got this huge population migration into the area. You have significant capital from Europe coming into the area to buy this same land and putting pressure on it. At what point and how do you kind of take into account the substitution aspect of timber if the prices become too high or cost of land becomes too competitive, to where we start to see a shift back towards either steel, concrete, or maybe even cross-laminated timber, which is actually a benefit.
Yeah.
I'd like to hear your thoughts.
Can I start on that?
Please.
Yeah. Open invitation to anyone and everyone in the room. If you would like to join me in the battle to get harvested wood products accounting and the substitution effect considered in global carbon reporting paradigms, let's come talk. We can do it after 6 o'clock if you like. We could do it tomorrow. This is a major thing. I think Mark Rogers' presentation earlier this morning, and even I didn't get him to look up. Thank you. Made a great point. This whole room, everything could come from timber, but at what price, how many trees in the ground to deliver that? This is a real question. But part of the issue is that the emissions frameworks we use to date have always been focused on the problem. How much carbon dioxide is going up? How much methane is going up? How do we equate that? We have not actually been looking at what's going right. And it was also mentioned earlier today, forestry, agriculture, land use is around 25% of global emissions. Not the case in the US. The forestry sector in the US is net sequesterer all the time, and private managed working forests are the engine of that. And that's because those forests are drawing down carbon, and we're also then putting around 100 million tons a year into the harvested wood products pool. But if we look at something like the annual report of, Nike, they're not putting into that the paperboard that goes into shoe boxes. What's the carbon storage of that? You know what? It's honestly not that long. It's probably a couple of years before it goes into recycling or landfill, but it's still keeping carbon out of the atmosphere for a couple of years. This guy is some sort of compressed composite fiberboard, which has got a medium-term life of, 20 to 30 years. Nobody's going to have this in their dining or their family room for 50 years, right? It's a little bit lower quality than that, but it's storing carbon for 20 or 30 years. So what we do with products accounting is try and understand how to put that value of carbon storage where every minute and every year that we keep a molecule of carbon dioxide out of the air back as a benefit that allows us to compare apples to apples with the emissions reporting. And institutional investors have done a fantastic job improving their understanding of carbon footprints in their portfolios. But what we haven't done a great job of is getting the benefits of good forestry and good land use into those reports. We've been saying, ta-da, a portfolio has X emissions per year, 100 tons of emissions per year. And then they say, and our forests store this much. Well, forests store this much is not comparable to a ton of emissions. But what we need to understand is net sequestration in the forests, what translates to the harvested wood products pool, and then this extra layer is super complicated, and I've got zero progress with the greenhouse gas protocol on this, but the substitution effect and what happens when we start in our world of displacing high carbon embodied products like concrete and steel with things that are storing wood. Folks are not ready for it, and kind of a certain branch of academia and scrutiny from the NGO community, which is healthy, have really stopped us from putting that benefit into the carbon accounting paradigms. But if we want to think transformationally about what it means to have a net zero economy and for renewable fibers, because land is finite, but renewable resources like wood can keep being grown on the same land sustainably over time, we need to understand the whole picture of what making a choice to use a renewable fiber, to use a fiber that stores carbon means in our life. And we need to stop pretending that it's just as simple as paper or plastic and how guilty we feel if we just throw away plastic. It's really that paper or plastic is what's coming out of the earth and what is going to be able to go back into use in the earth.
And I'll add, first of all, I totally agree that not accounting and, more importantly, crediting for harvested wood products for the sequestration qualities that they provide is limiting. It is limiting in the value creation opportunity for TIMOs and other forest managers. I'll relate our own story. So we've been tracking and reporting on our GHG emissions and removals through the GHG protocol guidelines for over 10 years. And on average, over the last 5 years, we've, just through our Timberland business, have resulted in a climate positive profile for Manulife as a whole. So there's huge potential and active sequestration that mainly traditional timber management provides. If we can extend that to harvested wood products, and I look at the registries for carbon crediting, harvested wood product accounting is included in baselines. It just doesn't translate that one extra step to actually be viable for crediting. That is a different leap. So we're right there with you. If we can make that happen, obviously you need the science, you need the tracking, and I think that in itself is a pretty large hurdle to get over, because you've got chain of custody issues once you leave the forest gate or have that delivery. You have to track this table. Is it IKEA's? Is it the end consumer? Who gets the share of that credit? And to sort that out, I think would go a long way.
Yeah, and speaking credit where credit is due, pun intended, Manulife has been right there in this carbon reporting exercise as well, and both from the sustainability team and putting dedicated consultants on it, because it is highly technical. It has been the nightmare of my pandemic with a lot of 7 a.m. working group phone calls, which are blissfully almost over, but we're not convinced that the protocol is coming out in a great place that's really gonna showcase the true climate impact of good forestry. So the mission continues, the invite is broader. Come join the few TIMOs that have been active in that for a few years and help us really get the good report card that good forestry should deserve. And hopefully we can get some challenging questions about how we further extend that impact from business as usual to business as unusual.
And if I could pick up part of your question, Joe, was the kind of influx of capital coming into specifically the U.S. timber market. We're absolutely seeing it. We're seeing competition increase, and we're seeing the range of competitor types increase. In particular, I think those with a carbon lens who maybe don't have a traditional timber management background are coming in, and I think that poses some risks. As we mentioned, these are interconnected markets. You need to understand where the opportunities and the potential challenges are in timber value management, as well as extending and capturing those opportunities with a carbon-focused approach.
Yeah, and I should say, this is something that can really scare our colleagues in the industry. When you start talking about storing carbon in forests, people can get innately concerned that you're just going to reduce harvest, which means fewer active jobs in the forest harvesting and hauling those trees. It means fewer jobs in the mills processing those trees. It means fewer jobs through the indirect benefits of those existing jobs. And it even goes back to the guys who sell the seedlings. They say, well, gosh, if you're going to harvest fewer trees per year, you're going to need fewer seedlings. What am I supposed to do? The thing is, we need to be better about communicating to our peers throughout the forest sector, not just the investment piece, that there are really net benefits for all in making the rational land use transition and putting forestry in a really strong place in that. But for that to work, it has to be about the full landscape of natural climate solutions, including managing, improving, and restoring forests and other lands, but also building that carbon in the built environment and really changing the way we live our lives to make use of low carbon, zero carbon, or carbon drawdown products in our daily life. That's a mission for all of us, I think.
So, kind of evolving through the industry as I have, I look back in kind of the early 2000s when the integrated forest products companies really disintegrated in a meaningful way. And there was a lot of cash that came in through the TIMO industry. And back to the point of kind of what's wrong with the TIMO industry in the US, I think at that time, most of the investors that were coming into the space were very happy with kind of the biologic return that came from the biologic engine. So, the trees are going to grow 4, 5, 6% a year. A lot of investors were pretty happy with that type of return in a stationary, non-correlated asset class with very tax efficient in the U.S. And so as you fast forward to now, those returns are kind of what have been the normal for the TIMO industry, plus or minus depending on the investment class. But the investors now are comparing that to other investments and are frustrated. So as I look at the capital that's coming into the space now and the objectives related to that, a lot of the investors are saying, I just need to offset my internal carbon footprint. I'm not really concerned about returns. I just need that carbon. I need that environmental benefit. I need the social benefit that comes from timberland ownership. And I'm concerned personally that in 10 years, 15 years, that passive management is going to lead to another issue with timberland returns in the United States. And so I guess for both of you that are placing capital for investors with those sorts of objectives, how do you discuss the need for actual return as well, so that you're able to do kind of the good things that need to happen from an active management standpoint to maintain the forest health and generate all the benefits that come from that?
Sure. I'm happy to lead off there. So, first I'll rewind further back in my career. I'm kind of 12 or 13 years into impact investing across a variety of sectors, and I think one of the original theses in impact investing was, there's a wealth of low-cost capital or subsidized capital out there to help kind of juice returns for impact. And generally, it's not true, right? There are many foundations out there doing good work. There are many DFIs, many of whom are represented here, that are doing great work. And that, compared to the commercial capital space, is minuscule. And generally, those organizations also have a risk-return profile. They're not just willing to put out full risk capital. So I think the perception of a risk return, well, I don't think there's a meaningful investor base that's actually willing to trade off impact for return. So that's one point. The vast majority of the investors and current clients that we speak to, they want their cake and they want to eat it too, right? They want market-based returns and they want the impact alongside it. And as we discussed, impact is embedded even with traditional core sustainable timber management. It's about extending that model even further to drive additional impacts. And I'd say, taking carbon as the prolific example from today and generally in the world right now, it's not necessarily a trade-off, right? You can still get market returns. You can even get potentially greater than market returns. It's all about what your expectations of the future price of carbon are. And depending on the intensity of your carbon focus through your timber management, that kind of changes the risk-return profile. The key driver isn't going to be timber prices anymore, stumpage prices. It's going to be carbon value. So it's not necessarily a trade-off. It's just a completely different risk-return profile. And the last thing I'll say is, for the U.S. in particular, improved forest management is a very kind of accepted and adopted carbon credit generation approach, carbon project activity. And for those of you not familiar, that basically means acquiring a working forest, so a standing forest, and changing your management regime intentionally so that you're sequestering additional carbon than otherwise would have happened in a business as usual case. That doesn't mean that you can't harvest any timber. It just means you have to stay above a baseline. So there are embedded mechanisms, proven mechanisms in the carbon markets, again, for example, that you can still have active, sustainable timber management, and I'd say that's the baseline. That's table stakes, as Mary Kate said. Almost all TIMOs in North America have that as a starting point with third-party certification, and then you go above and beyond that, and maybe take a different lens with carbon value. You're still managing the forest sustainably, and that certainly for Manulife is part and parcel of what we do.
Yeah, I'm going to try and answer without saying carbon, because you've addressed it amply, which is great, and we've talked about it a lot throughout the day. No, absolutely, go for it. I have an anthropology degree, so I'll talk about people, I guess. There are other impact components here, and I think when we start to bring them into focus, the perils of maybe a a passive land management strategy, which I will say is like pretty antithetical to those who've been investing in forestry for a long time. I think there is a perception that biological growth just happens and it drives a nice steady return, but there are lots of decisions that foresters make that ensure that is delivered. And we're a total returns asset class, and that means we've been traditionally trying to provide primarily timber revenue, but also other bits of things, and biological growth and appreciation. We're still going to need to do that as carbon prices rise. The decisions are going to get more complicated, but as we think about those 22 million acres that I mentioned in Georgia, there are 22 million acres of private managed forests in Georgia. That is a lot of people who own, who live next to, who recreate in, who enjoy, and who benefit from forests. And if we start managing those differently, that's an entire state of people who are going to be affected. It's jobs that are going to be affected. It's rural towns and communities that are going to be affected. And this is honestly something I've really come to appreciate in the past 13 months with FIA, because I'm working in a different TIMO culture than when I was based in an APAC kind of focused one and looking at development projects in Southeast Asia. My colleagues are people who grew up in the woods, a good number of them with family members from the forest sector who are used to hunting, fishing, hiking, camping in the woods. And I really now understand that value as someone who, frankly, I don't think I went to a national park till I was 19, never camped until I was over 20. I am like a little weirdo in our company, and Dan will attest that I'm pretty much weirdo number one at this point. But this is important to me because it's been an education to really understand the role it plays in a different part of the country. And we do see that in developing economies. And I knew it and I understood it somehow more in Malaysia than I did understand it in the US because I hadn't been exposed to it growing up. I think that comes a little bit back to that public perception and public relations problem I mentioned before. But if we think about the effect of our forests and land management on people, I think we're going to be driven to make better long-term decisions. And I think we are also reaching a bit of a tipping point where harm to the environment and society is going to be no longer tolerated from the corporate sector. We know companies have been getting away with a lot for a really, really, really long time. I want to thank the EU for putting the concept of responsible business conduct as an expectation for all of their institutional investors. Responsible business conduct is not just anti-corruption and bribery. It means understanding the risks of your business to environment, society, and managing those. That is actually a paradigm shift that I don't know if folks understood this was happening, but now every one of us who has a European client, that client's going, could you please explain to me how you comply with this requirement for responsible business conduct? And please, can you sign off on all these criteria that you're managing to? Those are rising expectations that we can take forward to reinforce how and why we manage land responsibly, not just to give a financial return, but to give a truly durable financial return where forests are valued in society. Because if they're not valued in society, that financial return is going to crater at some point when the social license is in the tubes.
So process check. We've got just a few minutes left, and I know we haven't taken any questions from the audience.
Okay.
I don't see any on the screen, so I guess maybe we can go out to the floor to take some questions.
Yeah, but did I understand correctly? You said you had something like 100. Oh, there we go. Well, you had, not we. I don't have any. You had something like 127,000 hectares forestry. And anyway, the question is: are you limited to your tree stock at the moment? Is that what you're saying? You can't.
No,
you can't,
I must have gotten lost. That's for me, Phil. Is that right?
Well, it's whoever said it. I can't.
We manage around 2 million acres.
Yeah, that was a rubbish figure.
I think you were saying
We
the
manage around 6
institutional
million.
grade assets in the U.S. maybe?
Yeah, that was for the whole market.
Right.
We've calculated as around 120 million acres.
Okay. So when you gave your example about the impact on a whole state of people that are used to camping and whatever else they
Yeah.
do, surely can you not go somewhere else and leave that as it is, or this is what I don't quite understand. It sounds like you're in the straitjacket. I can't believe you are in such a vast territory.
Yeah, well, I think the industry is somewhat constrained by availability of scaled assets we can buy right now, and that is for sure a thing. There are big deals that have come up this year There are more that may come along, and it gets competitive. Prices are going nuts, and that's not limited to North America. That's happening in all the major timberland markets. We're seeing that happen. So I wouldn't say we're in a straitjacket, but we are in a battle to get your hands on assets at the right price. I will say FIA's been a net seller over the past couple of years because it is a seller's market in timberland right now in the US. You are getting phenomenal prices. There was recently a deal, I think in the Carolinas, at $3,500 an acre. That is, you don't know, that is insane. If you compare that to the average that you were stating, going from 120 million acres to 150 billion, you know, that's a real premium that's going in some of these places. So I'd say there is a little bit of constraint for good assets right now, and that means we have to be driven to price the ESG benefits and values of those. As to the other parts of working forests, so I had fun stats here, but you gave so many area stats, I didn't give them to start. But in the US, there's over 500 million acres of forests, of private forests, and around 2/3 of those are privately managed forests. That's 2 states of Texas worth of privately managed working forests. That is a lot of land and a lot of trees. But there's also a lot that is held in private ownership, and I think, Joe, you could probably speak to this better, but it's harder for us to aggregate and deploy capital at scale with the diligence and confidence we need for institutional investors to aggregate that up into an operating scale that's attractive. That's just a hard play. Also, those forests are part of families, and they're part of family legacies, and those guys want to, you know, go back for family reunions and hunts every year on their forests, and that's something for a lot of people, as well as those that, you know they own a forest, they know they probably don't have to do a whole lot with it for 20, 30 years till they think about inviting a consulting forester on to come evaluate it and market for a timber sale. Those properties, I should say, are less rigorously managed than the institutional grade that we're talking about. They sequester less carbon, they produce less timber because they're not managed as intensively for value.
And I think that's a huge untapped area of the United States from an ESG standpoint. So most of the private land, the non-industrial private land, is not certified. It's undermanaged or poorly managed. And so as we are able to dip into that market, grab those properties, repair them in some way, we get tremendous additionality from an ESG standpoint. And actually was talking to a family member that we bought some property from. There's actually a social benefit to it that's overlooked in that, you know, a lot of the times these are legacy properties that grandfather bought, great-grandfather bought. Now the kids have these properties. There's little liquidity there. It's tied up, and they have no access to selling that property to buy other things like pay for college or pay for other parts of their lives. And so if we can unlock that value, provide a social benefit to that family with this asset that's locked up in a way, and get additionality from an ESG standpoint, it's a huge win proposition. It's just very, very difficult market to access.
One other thing I'll note, you know, I think you had mentioned leaving a forest alone, and you know, for certain parts of the world, tropical forests especially, you know, maintaining the integrity of those forests is incredibly important. For other regions, you know, I live in California. You may have heard of our wildfire problem. You know, often not actively managing forests and not removing some of those fuels results in catastrophic wildfires. Mm-hmm. On our actively managed lands, and I'm sure it's the same with FIA, that risk goes much, much lower. So it's self-insurance with our sustainable practices.
Yes.
You do, but we are
can't hear you
3
online,
minutes over, so
yeah.
last question.
Just a quick question. Would you look at anywhere outside of America? You know, because the tropical places are where all this biodiversity lives. You all have a lot of money. And, you know, when emerging markets are going to have interest rate rises in America, all that money is going to go back. Those currencies are going to go dong. And all those countries are going to struggle with repayments. So you have, especially in the tropics, a lot of countries, Sri Lanka was just the first, trust me. There will be others. So it's a very good time to come and actually say to these countries, listen, don't cut this forest down. We'll pay you to keep it. And then all of a sudden you bail them. But you will be able to, in chaos, is when you can actually have sensible conversations with politicians in developing countries. So it will be really great. I mean, I know you're Nature Conservancy. I'm a big admirer of what you've done there. But if Manulife can have private sector capital doing this, it will be, can I have a conversation with you after this? Will be.
Yeah.
So that's what I want to know. Can you do this? If it is, can we please talk after this?
Yeah, so first, we are a global investment manager in Timberland. We have a base in North America, but we are active in South America, specifically Brazil and Chile, as well as Australia and New Zealand, so the main global institutional timber markets. I'd say further down the road, we're certainly looking into additional geographies that are deeper into Latin America, for instance, and elsewhere like Southeast Asia, potentially South Asia. For us, we kind of are starting with an institutional client base, institutional investor base, and it's going to be a calculated expansion. We're going to do our diligence. We're going to make sure that we have the right partners on the ground. And ultimately, I think this is a through line throughout institutional investment. There has to be the risk-reward match. And for certain investors, understanding timberland investment is the first step. As was mentioned in the previous panel, it's not an asset class for everyone. It has very unique long-term characteristics. There's a level of kind of education within core timberland, let alone other nature-based solutions, carbon, biodiversity, et cetera. So expanding to emerging markets that have just a different risk profile, I think is a longer-term goal, but absolutely, and certainly some TIMOs do invest there already. It's a growing focus.
Yeah, there's a risk reward plus that impact dimension mismatch between the capital flows right now and those project profiles and the capabilities in sort of some of the established TIMO sector to take on much higher levels of ESG risk, as well as factoring in other risks, like the market risks are different, the timber market risks are way different, operating condition risks are different, sovereign risks are different. So we have to account for all those things and stack up a return that's basically going to compensate and find a client who's willing to pay the management fee that it takes to have a more hands-on approach to those types of assets. I absolutely think it's happening. We've seen it where North America, as the most liquid timberland market, has existed for 35, 40 years. We've seen South America professionalize in an institutional way. We've seen Australia and New Zealand take off to where they're pretty saturated with a strong institutional market there. Not emerging, but it's just showing the growth of the kind of investment model. We've seen some of it in Asia. We've seen some of it in Africa. And I think the TIMOs are willing to look at any asset that's going to give a risk return profile that a client will accept. So a big challenge for all of us is to have a lot of conversations with the market. It's not a cookie cutter exercise. Our business is around 80% separately managed accounts, which means we don't just kind of run 4 or 5 funds and we decide how it's going to be and exactly what it looks like and find people to fall into them. Every client has its mandate, and we need to match the risk appetite, their return expectations, their cash flow needs, all of those things over the long term. For those that will take on emerging markets, fantastic. Even those that will get into frontier assets, terrific. And we're doing it. I mean, I've worked on forestry projects and assets across more than a dozen countries or so, and I'm not close to the most experienced kind of global forestry person at all. So it happens. It's just not at the scale we see in the US yet.
So we are between this group and drinks,
Yes.
and whoever's at home and other activities.
Yeah.
Is there any more questions that you want to put given that
that.
constraint?
Yos.
Sure.
I just.
What's the institutional investment into forestry globally? David Brown used to tell us.
Yeah, I can think of someone who used to help him come up with those numbers. Yeah, I would say the asset class is in total around 200 if you're including the REITs, probably growing a little bit. As Eric said, there are studies that are saying we should be able to get this asset class to $1 trillion when we price in carbon, biodiversity, and start really getting into greenfields in a meaningful way. It's large. I mean, I think what TIMOs were probably now 125, 130. Look at the Timberlink survey, not Timberlink Sawmill, but Timberlink, Tracy Evans, and Gary. Yeah, Gary Myers.
All right, I'm getting the big hook from the drinkers in the audience, so we'll wrap it up. Thanks so much.